Hi, this is Uncle Dan, and today we're going to talk about selling covered calls using interactive brokers. Now, a friend of mine approached me yesterday and said, "Hey, Uncle, can you help me? I'm long NIO stock. My cost basis is 31, the stock's at 40, but I'm worried about the market dropping over the next 6 months." What I'm thinking about for him is if you're using interactive brokers, you could have a watch list on one side of your screen, and then you could set up the option chain on the other side. Now, what I did here is I changed it from a tabbed view to a list view. And the reason why I did this is I'm picking out a few strikes that I like, and I'm looking across the time frames from April all the way to January. Put in a column in here, which is the implied volatility, how expensive the premiums are in here. And what I noticed here in January, we have 60 calls that are trading for almost $5. I'm thinking to myself, if he owns the stock at 32, if we were to sell 60 calls in January, we could later on buy these back even if the stock moves higher. So what I want to suggest here is that with over 70% implied volatility on these, if we were to sell these for $5, that means that if the stock trades above 65, he'll be taken out, which means he'll make 100% return on his money. If the stock doesn't exceed 60 by the end of the year, that means his cost basis will reduce from, say, 32 down to 27. So I kind of like this trade because if it was me, I would be happy to take profits in the stock at 65 by the end of the year and make 100% return on my capital. So let's look at this and go, okay, so now what we're going to do is we're going to click on this. We're going to click on the bid. It says we're selling a call. Quantity of one in options would be the equivalent of 100 shares of stock. So if I own 100 shares of stock at 32, and if I sell a 60 call, then basically if the stock gets above 60 by January, they'll take my stock away, but I get to keep the premium. So I'm really doing is selling it at $65, because what I'm going to do here is, although the bid is $455, I don't have to sell it at whatever the market maker is bidding. In other words, I can leave an order at, say, $5, and then I can come down here and say make it GTC, which means my order will stay for the next 6 months until I get filled. Now if I go to my order screen, I'm going to see that I've now picked a January 60 call to sell for $5. So why am I doing that? I'm basically saying that when the stock goes higher, and right now we can see it's trading at 40.61. This stock moves up another $1, I should get filled at 5. So we're guessing, but that should be what happens. So I'm going to leave that order in there, and then if the market spikes up unexpectedly and someone rushes in to buy these calls, then I'll sell it at 5. That means I'm capped. That means if the stock trades above 60 by January, I will not be able to continue to make unlimited profits to the upside. But I'm happy to be capped because I'm going to collect $500, assuming we move up a little bit, and that's going to reduce my cost basis by $5. That's how we sell a covered call in interactive brokers. So good luck.